What if I told you the next big market crash could be your golden ticket to become financially free in Singapore? Not 30 years later, but way sooner. Sounds a bit crazy, right? But while most people panic during a crash, smart investors get rich quietly. Not by gambling, but by buying strong dividend-paying blue-chip stocks like DBS and OCBC when they're on discount. And in this video, I'll show you what causes crashes, how to spot great buying opportunities, and why collecting dividends is better than just being rich on paper. So stick with me till the end, because these lessons could change how you invest forever. Oh, and don't forget to smash that like button, hit subscribe, and join the community here at Wealth for You, where we break down investing the smart, simple, Singaporean way. Disclaimer though, this video is for educational purposes only. It's not financial advice. Please do your own research or speak with a licensed advisor before investing. Section 1. Why do markets crash? Let me paint you a picture. You open your brokerage app. Your portfolio is red, minus, minus. You refresh, still red. Heart also a bit pain. Before you panic sell everything, pause. Let's understand why markets crash in the first place. Because when you understand the why, you stop reacting emotionally. Over the years, crashes usually happen for three main reasons. First, bubble bursts. Imagine everyone chasing the next big thing, throwing money at it, hyping it up, FOMOing into stocks without checking the fundamentals. That's what happened in the dot-com bubble. Investors poured money into any company with a .com in its name. Some didn't even have a working product or profit. Prices soared. But hype doesn't last forever. When reality hit, the bubble popped, and stock prices came crashing down. Second, bad economy or government policies. When inflation shoots up, your kopi, chai fun, everything gets more expensive. People spend less. Businesses earn less, investors get worried, and to make things worse, central banks, like the Fed, raise interest rates to fight inflation. That makes loans more expensive. Businesses tighten up, and investor confidence drops. So what happens? Stocks fall, people panic, the market drops further. Third, black swan events. These are unexpected shocks to the system. Events no one sees coming. Think of 9/11, COVID-19, wars, or massive financial scandals. They create fear. And when fear spreads in the market, people rush to sell. Fast. That's when you see steep drops in a matter of days, sometimes hours. But here's the most important part. Every crash eventually recovers. Yes, even the dot-com crash, the global financial crisis, even COVID-19. The market falls. Investors panic. But the strong businesses survive. And when confidence returns, the market rebounds. If you understand this cycle, you won't just survive the next crash. You might actually come out of it richer. Section 2. Are crashes normal? Let's be honest. When your stocks start dropping, it's natural to feel anxious. But here's the truth most people don't realize. Crashes are completely normal. They're part of the game. In fact, the market is like a roller coaster. It goes up, it goes down, and then it goes up again. This isn't randomness. It's a pattern, a cycle. And if you understand the cycle, you won't be surprised the next time your portfolio turns red. Let me break it down. Pullbacks happen almost every year. Prices drop around 5 to 10%, usually just short-term noise. Corrections are a bit steeper, a 10 to 20% drop, and they happen every 1 to 2 years as prices correct from being overvalued. Then come bear markets, 20 to 40% down. These show up about once every 5 to 6 years, often due to recessions or high interest rates. And finally, the big one. Crashes, where markets plunge 40% or more. These happen roughly once every 10 to 20 years, triggered by global crises. Sounds scary, right? But here's the part that most people miss. Every single crash in history has recovered. Let's look at the record. 1973 oil crisis? Brutal at the time, but it recovered. Black Monday in 1987? The market crashed 22% in a single day. Recovered in 2 years. 2008 global financial crisis? S&P 500 down nearly 50%. Recovered in 4 years. COVID-19 crash in 2020? Recovered in just 4 months. So if you don't panic, if you don't sell at the bottom, and if you continue to buy good, strong companies, you don't just survive a crash, you could come out of it richer than ever. That's the power of understanding market cycles. Section 3. Crash Buying, the DBS OCBC Opportunity. All right, now let's talk about one of the smartest moves you can make during a crash, something called crash buying. And trust me, this one's especially powerful for Singapore investors. When the market crashes, even strong, rock-solid companies like DBS and OCBC get dragged down. Not because they're bad businesses, but because everyone is panicking. And here's the beauty of that moment. You can buy these giants at prices close to or even below their net asset value or NAV. Let's take a real example. During the 2020 COVID crash, DBS dropped to around $17 per share. At the time, its NAV was about $18 to $19. That's like buying a luxury condo in Orchard at BTO prices in Punggol. Crazy deal, right? Fast forward to today. DBS is trading at over $40, and it's still paying out consistent dividends. Now imagine this. If you had bought at $17, your dividend yield on cost would be around 12%, based on full-year dividend of $2.16 in 2024. Compare that to someone who's buying DBS now and only getting 4 to 5%. Same company, same dividend. But because you bought during the crash, your income is permanently higher. That's the magic formula. Crash buying plus dividend investing equals lifelong passive income at a much better yield. It's like locking in a better deal forever. And the best part? You didn't have to be lucky. You just had to be ready when others were afraid. Section 4. Dividend stocks equals passive income. Let's be real. Not all companies survive a crash. But solid blue-chip stocks like DBS, OCBC, UOB, these are Singapore's financial backbone. They make money, pay dividends, and recover stronger. When you own them at low prices, you lock in a high yield. That means every quarter you receive dividends without needing to work extra. Imagine collecting $1,000 every few months while still working your regular job. That's your bonus Kopi fund, your holiday money, your early retirement ticket. Section 5. How to spot buying opportunities. So, let's say you're ready. You've seen the market crashing, your hands are itchy to invest. But you're wondering, how do I know when to buy? Good question. Crash buying isn't just about buying when prices drop. It's about buying the right stocks at the right time. Here's how you do it like a pro. First, pay attention to the headlines. When you see the news shouting, "Recession fears hit global markets," or "Stock market plunges to new lows," that's not the time to panic. It's your signal to start researching. When everyone else is selling, that's when opportunity quietly shows up. Second, compare stock price to NAV. This one is especially useful for banks like DBS, OCBC, or UOB. Check their net asset value, or NAV. Basically, how much the company is worth per share based on its actual balance sheet. Now here's the golden rule. If the share price drops close to or below the NAV, it usually means the stock is undervalued. It's like walking into a store and seeing a $10 note being sold for $8. You'd buy it, right? Same logic applies here. Third, don't all in one shot. Now, a lot of people try to be hero during a crash. They want to find the exact bottom, the lowest price possible, and throw in all their cash at once. But let's be real. Timing the bottom is almost impossible. It's like trying to find the cheapest durian in Geelong, blindfolded. Section 6. Real wealth equals cash flow, not just assets. Let's bust one of the biggest money myths in Singapore. You see, many Singaporeans are asset-rich. They own a condo, maybe a car, some even a second property. On paper, they look successful. But here's the problem. All that wealth? It's locked up. You can't spend your condo. You can't pay bills with bricks. So despite owning a lot, they might still depend fully on their job, worry about retirement, and stress over monthly mortgage payments that feel heavier than their gym dumbbells. That's not freedom. That's just a different kind of financial pressure. Now compare that to someone who is cash flow rich. They might not drive a luxury car or live in a landed house, but they own income-producing assets, like blue-chip dividend stocks. Every quarter, they receive passive income from companies like DBS or OCBC. They don't need to sell anything to fund their lifestyle. Their money is working for them, quietly, in the background. That's real financial peace of mind. Passive income. No need to sell assets. Flexibility to make life decisions without financial fear. And the best part? It all starts when you take action during a market crash, buying strong dividend stocks while everyone else is panicking. Because in the end, it's not about how much you own, it's about how much your money can pay you back. That's cash flow freedom, and that's how real wealth is built. Final thoughts. Turn crisis into cash flow. So the next time your portfolio turns red and the headlines scream market crash, don't panic. Don't sell. Instead, take a deep breath and do what the smart investors do. Research. Look for undervalued dividend stocks like DBS or OCBC and start building your passive income machine, one solid company at a time. Because here's the truth. The market always recovers. It has, again and again. And when it does, you won't just be sitting on capital gains. You'll have a steady income stream that pays you, quarter after quarter, for years to come. Found this video helpful? Give it a like to let the YouTube algorithm know. Subscribe to Wealth for You, where we make investing simple, local, and stress-free for Singaporeans. Got questions on blue-chip stocks, dividend strategies, or crash buying? Drop them in the comments. I'd love to hear from you. And remember, panic sellers lose, dividend collectors win. This is your time. Let's stop chasing wealth and start building it for you.